It is Thursday, January 22nd, 2026. And honestly, just looking at the calendar feels a bit surreal after the year we just had.
He really does.
2025 was one for the memoirs. We watched Bitcoin scream up to that all-time high of, what, $126,080?
Mm-hmm.
And then, we watched the inevitable gravity take hold. It was exhilarating. It was exhausting. And now here we are in 2026 trying to figure out if the ground has settled.
I'm not sure it's settled so much as the tectonic plates have just completely rearranged themselves.
Yeah.
If you look at the stack of reports we have here, Bitwise, The Motley Fool, Bybit, EarnPark, some pretty dense academic papers, the consensus seems to be that the old maps just don't work anymore.
That's the big theme jumping out at me. For a decade, everyone worshipped the 4-year cycle.
It was like a religion.
Absolutely. Halving, bull run, crash, crypto winter. Rinse and repeat. And by that logic, 2026 is supposed to be the hangover year. We should be shivering in a crypto winter right now.
We should be. But the data from Bitwise suggests the heater is still running full blast.
So, is it broken? Is the cycle dead?
Broken is the word they used, and I think it fits. The argument is that the forces that used to drive those violent cycles are kind of evaporating.
What forces are we talking about?
Well, think about 2018 or 2022. Those crashes were fueled by interest rate shocks and, more importantly, these massive leverage blowups.
Right. All the retail traders with 100x leverage.
Exactly, and lenders playing fast and loose. Bybit's outlook points out that the driver's seat is occupied by a totally different demographic now. It's macro policy and institutions.
Suits have taken over.
In a way, yeah.
Yeah.
And institutions, they don't trade based on a 4-year halving schedule. They trade on asset allocation models and risk-adjusted returns.
Which brings us to the supply and demand math, because this is where that cycle is dead argument really gets its teeth.
It really does.
I was looking at the flow data from Bitwise on the spot ETFs. It's staggering.
A classic supply shock, but it's one that's happening in slow motion.
The numbers are wild. For Bitcoin, the ETFs bought something like 710,000 BTC in a period where the network only issued about 363,000 new coins.
Yeah.
That's nearly a 2-to-1 ratio. You don't need a PhD in economics to know that if demand doubles supply, the price floor rises.
And that floor is solidifying. What's coming in 2026 is what some analysts are calling ETF Palooza.
ETF Palooza.
We're looking at potentially over 100 new crypto-linked ETFs launching in the U.S. this year alone.
100? Wow. So I'm guessing we aren't just talking about vanilla buy Bitcoin funds anymore.
No, the market is getting much more sophisticated. We're talking about staking ETFs where the fund captures the yield, index ETFs that track a whole basket of assets, really complex strategy funds.
And all that creates a sort of dampening effect on volatility, right?
A huge one.
Speaking of volatility, that was the most shocking stat for me. It's my new favorite dinner party fact. For all of 2025, Bitcoin was actually less volatile than NVIDIA.
It really signals a fundamental de-risking of the asset class.
How?
Well, when you have pension funds and endowments allocating, say, 1 or 2% of a multi-billion-dollar portfolio, they don't panic sell because of a bad tweet.
Right.
They rebalance quarterly. That stabilizes everything. So 2026 might be the year crypto finally sheds its reputation as a casino and starts acting like, well, a mature asset class.
Okay, so boring might be good for the retirement account, but nobody listens to a deep dive to hear about how stable everything is.
Fair enough.
We want to know where the growth is. If Bitcoin is the boring savings account now, the reports from the Motley Fool and Binance Square seem to think the high-speed layer ones are where the action is.
That's where the utility narrative really kicks in. If Bitcoin is digital gold, these network are the digital highways. And Solana is the one taking up all the oxygen in the room.
Fire dancer, I see that word everywhere.
Yeah.
The headline is always 1 million transactions per second, which sounds amazing, but focusing just on the speed kind of misses the point, doesn't it?
You have absolutely hit the nail on the head. Yes, the speed is great for headlines, but Fire Dancer is actually a completely new validator client. It's a total rewrite of the network software.
And why does that matter?
Well, right now, if the original Solana client has a critical bug, the whole network can halt. We've all seen that happen.
Right, the infamous outages.
Fire Dancer introduces client diversity. It means you have a backup system. For an institution like, say, PayPal or Visa, that redundancy is non-negotiable. They don't care about 1 million TPS if the network goes down for 4 hours.
So Fire Dancer solves the reliability problem.
Which is the real key to getting those big institutions on board.
So Solana is chasing speed and reliability. And then you've got XRP, which seems to finally be out of the penalty box.
Post-lawsuit clarity is a powerful drug. For years, Ripple couldn't make deals in the West. Now that legal fog is lifted, they are aggressively expanding their banking partnerships again.
So less about new tech, more about just being allowed to do business.
Pretty much.
But you can't build a financial system just on highways. You need the plumbing, right?
Of course.
And the infrastructure reports keep bringing up Chainlink and the graph as the picks and shovels of this gold rush.
They are the unsexy backend that makes everything else work. Chainlink is really interesting because of the whole real-world asset or RWA narrative.
The idea that you can trade like U.S. Treasuries on a blockchain 24/7.
Exactly. But a blockchain can't see the interest rate of a T-bill. It's an island. Chainlink is the bridge. It's the oracle that feeds it real-world data.
So if you believe trillions of dollars of assets are moving on-chain,
You have to believe in the system that feeds them pricing data. Without Chainlink, those assets are just flying blind.
and the graph,
Think of it like the Google of blockchain data. Blockchains are just messy ledgers. The graph indexes all that data, so developers can actually build apps that are responsive and useful. It's pure utility.
Okay, before we move on, one name in the Motley Fool report felt like a real outlier, Monero. In a world obsessed with regulatory clarity and ETFs, a privacy coin that the government explicitly hates seems like a very dangerous play.
It is the ultimate contrarian play. It's designed to be untraceable. It appeals to people who are, terrified of the surveillance state.
But the risk is huge. Exchanges are delisting it.
The risk is existential, yeah. It's a bet that a black market economy will always exist and will always need a currency, regardless of what regulators think.
Let's pivot from the financial plumbing to the sci-fi stuff, because this is where the source material got really fascinating, the convergence of AI and crypto.
This is probably the most significant structural shift for 2026. We're not just talking about AI coins riding a hype wave. We're talking about AI agents becoming economic actors.
Fetch.ai is the leader here, right? The concept has blew my mind a bit. The idea that a piece of software has its own wallet.
It completely changes the definition of a consumer. Imagine an AI travel agent that doesn't just find you a flight, but books it, pays for it, and handles the insurance all by itself.
No human input.
None. Or imagine two AIs negotiating. One has data, the other needs it. They negotiate a price and settle the transaction in milliseconds using crypto.
And this connects directly to the APIN trend, decentralized physical infrastructure networks.
Yeah.
Because if these AI agents need resources, they have to get them from somewhere.
And that somewhere is us. DePIN is all about using tokens to incentivize regular people to build out physical infrastructure.
It's sort of the Airbnb model, but for utilities.
That's a great analogy. Take Render. We have a massive shortage of GPU power for AI. Render lets you rent out the idle power of your gaming PC to the network. An AI agent can then pay you for that power.
Or Hive Mapper, where you put a dash cam in your car and get paid to map roads, competing with Google.
Yeah.
But the source that really stuck with me was the academic paper on resilience. They weren't looking at the money. They were looking at the stability of these networks.
That paper was crucial. They analyzed the Brooklyn microgrid. In a traditional power grid, there's a central plant. If it fails, the lights go out for everyone.
A single point of failure.
Exactly, but the Brooklyn microgrid is just neighbors selling solar power to each other. It's a mesh. If one house disconnects, the network just heals around it. The paper argues that DePIN is a superior architecture for critical infrastructure because it's anti-fragile.
Okay, to make all of this decentralized tech fast enough, we need speed. Which brings us to the nerd corner. Zero-knowledge proofs. ZKPs.
Ah, yes. We have the study on the Plonky 2 framework. I love that name.
Clunky too. It sounds goofy, but the implications are huge. The usual explanation for ZKPs is about privacy, right? Like proving I'm over 21 without showing my ID.
That's the classic example.
But reading the study on its application on the near blockchain, it seemed like the real breakthrough isn't privacy, it's compression.
That is the aha moment. Privacy is a great side effect, but scaling is the killer app. Normally, every node on a blockchain has to verify every single transaction. It's slow.
Right.
With a ZKP, you bundle thousands of transactions together, generate one tiny mathematical proof that says all of these are valid, and the network only has to check that one proof.
So you're turning a mountain of data into a molehill.
And verifying that molehill takes milliseconds. Plonky 2 is proving this is fast enough for real-time use. It basically solves the blockchain trilemma. You get decentralization, security, and now, finally, scalability.
Which bridges the gap to the final piece of the puzzle, adoption. Because for years, the user experience was a nightmare.
Mm-hmm. Write down this 24-word seed phrase.
Right. Don't lose it or you lose your life savings. But the U-Quoted report on Web3 shopping suggests we're turning a corner on who is actually using this stuff.
The demographic shift is undeniable. It's heavily skewed toward Gen Z, the 18 to 24 bracket. And they aren't hoarding Bitcoin. They're spending it.
On what? The report listed electronics, gaming items, and mobile top-ups.
Which tells you something about where this is happening. The hotspots are Latin America, Argentina, Brazil, El Salvador, and Nigeria.
Places where the local currency is.
Yeah.
Let's just say unreliable.
Unreliable is polite. If you're in Argentina and inflation is over 100%, holding pesos is like holding melting ice. Stablecoins are a survival tool. It's a way to opt out.
That Bitwise prediction about stablecoins hitting a $500 billion market cap really highlights this. But they also threw up a warning flag.
They did. They think 2026 is the year stablecoins get too successful.
And success draws targets.
Exactly. Bitwise predicts that emerging market governments will start blaming stablecoins for their own currency problems. We're going to see capital controls and maybe even bans as governments try to stop the bleeding.
It's a messy transition. And on the other end of the spectrum, you have prediction markets. We have to mention Polymarket.
Oh, yeah. The rise of prediction markets. It was the breakout star of 2024, but the expectation is that 2026 will dwarf those numbers as it expands in the U.S. It's becoming a truth machine.
So we have the macro shift, new infrastructure, AI convergence, real-world adoption. The picture is clear, but the action plan isn't. How do you navigate this? The Motley Fool had a pretty stark warning.
They did. They reminded us that most cryptocurrencies go to zero. Investing in small-cap projects is like throwing darts at a wall.
So how do you build a portfolio for 2026 without blowing yourself up? Earn Park laid out a tiered risk strategy that I thought was really practical.
It's disciplined. They suggest a conservative bucket, 40 to 60% of your portfolio. This is your Bitcoin, your Ethereum, maybe some yield-bearing stablecoins, the ballast of the ship.
Okay, then you step up to the balanced bucket.
That's 25 to 40%. Here you put the established winners, Solana, Polygon, Chainlink, protocols that have real usage and have survived a bear market.
And finally, the Vegas money, the aggressive bucket.
10 to 25%. This is for your Fetch.ai, your DePIN projects. This is where you look for the 10x returns. But, and this is the crucial part, if that bucket goes to zero, you don't lose your house.
And the key to making it all work is automated rebalancing.
You have to take emotion out of it. If your aggressive bucket doubles, your gut says, let it ride. The strategy says, sell.
Sell high, buy low. It sounds so easy.
It does until you actually have to click the button. That's why you let the software click it for you.
Wrapping this all up, looking at the landscape for 2026, it feels like we're in a strange place. The prices are high, the tech is maturing, but the hype feels different. It's less manic.
I think if I had to summarize 2026, I'd say it's the year of boring maturity disguised as a bull market. We have regulatory clarity coming, maybe the Clarity Act in the U.S. The infrastructure is finally catching up.
And the institutional pivot. That prediction about Ivy League endowments following Brown University's lead and starting to allocate.
That is the ultimate signal. When the Harvard and Yale endowments enter the chat, the stigma of crypto is officially dead. It's just another asset class.
It's a brave new world. But I want to leave you with one final thought I've been chewing on since we talked about those AI agents.
Okay.
We discussed Fetch.ai and render bots, paying bots for data and compute, the machine-to-machine economy. So if we are moving toward a world where the primary users of money, the ones doing the highest volume of transactions, aren't humans anymore, but AI agents, does market psychology even matter anymore? Does a 4-year cycle based on human fear and greed just become irrelevant because the bots don't get scared?
That is the trillion-dollar philosophical question. If the economy runs on code, maybe the market cycles will too.
Something to think about while you're rebalancing that portfolio.
That's it for this deep dive into the crypto landscape of 2026. Thanks for listening, and we'll catch you on the next one.